Good afternoon, everybody, and welcome to the latest in our series of professional advisors working lunches, today brought to you courtesy of our partner, Baillie Gifford. I'm Hope Williams-Smith, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. It will just ensure that there's no background noise so that our speaker can be heard nice and clearly. I should also inform you that this session is being recorded, and we will share a link of that recording by tomorrow. Do feel free to share this with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD and will be sending your proof of attendance to you via email tomorrow. Please kindly ensure that we can see your full name on Zoom so that we can get this to you. Now, in an ever-changing world, the ability to recognise that growth can be delivered in different ways and having the patience to allow it to flourish is key. To address those challenges and answer any questions you wish to ask him, I'm delighted to be joined today by Jon Henry, who is the Investment Specialist Director at Baillie Gifford, with specific responsibility for their Monks Investment Trust. Over the next hour, Jon will consider the merits of a diversified portfolio of growth stocks and the investment themes underpinning the future growth of the Monks Investment Trust. Do feel free to put any and all of your questions to Jon using the chat function, which you will find in the bottom right-hand corner of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your question, and only I will see it. So, just before I hand over to Jon, let me quickly run you through our learning objectives for today. So by the end of this session, delegates will be able to outline the attraction of long-term growth investing, describe the merits of thinking broadly about growth and embracing a diversified portfolio, and understand why Monks can be an attractive core holding for savers. So that is the CPD covered. Let's hear from Baillie Gifford's Jon Henry. Good afternoon, Jon.
Afternoon, Hope, and thank you very much for the introduction, and good afternoon, everybody who's tuned in. Thank you very much for taking the time to listen to this presentation. As Hope said, I'm a specialist and director at Baillie Gifford's clients department, and I work closely with the portfolio managers who look after the Monks Investment Trust. Hope has very helpfully outlined the learning objectives, which I hope I can address through the presentation in the next sort of half an hour to 45 minutes or so. But before I do that, I thought just in case anybody's not familiar with Monks, it was probably sensible to start with the bare bones of what Monks is. Monks is an investment trust. It's diversified. It's a portfolio of growth equities from right around the world that we believe can deliver a superior capital growth for savers over the long term. And when I say long term, we're looking at periods of 5 years or more. The trust is intentionally simple, modestly geared, with a modest level of exposure to unlisted securities. So the most of the fund is made up really of larger listed equity securities. Now, investing is difficult, regardless, to be honest, of your style or your philosophy, whatever persuasion, growth, value, or somewhere in between. Delivering attractive returns is difficult, and it always has been. And I thought we would start by asking a question to you all and seeing what your views are, by having a short poll on the Zoom call here. What you will get the option to do is select one of two answers. Investment markets continue to focus on the direction of interest rates, and have, to a large extent, that's been quite central to the direction of share prices and markets over the course of the last 12 months. Do you think rates will be higher or lower over the course of the next 12 months? So we'll take a look at the results when they come in. In the meantime, I'll share my screen, which has got some slides that I want to talk to you about. Here we go. Hopefully you can all see that in front cover there. I think the best place to start is to acknowledge the extraordinary period that we all find ourselves in through the course of the last 18 months or so. And you can see there on the chart on the right-hand side, I want to just bring this to your attention specifically. This shows the performance of the 75 largest growth equities over the last 5 years to the end of December. And what you can see is that this index of big growers, as you might call them, have tripled in share price terms through to the end of December 2021, only then to give it all back and more through to the end of last year. Now, of course, this all started with the onset of the pandemic, as some of these large tech businesses began to do very well as a result of people using and utilizing their services online. But once economies and society began to open up once again, demand normalized, and it became clear which businesses had failed to or mismanaged their businesses. And in many cases, this has led to many to write off growth investing. Now, there have been no shortage of sticks with which to beat the growth investor over the last couple of years. But some up on the slide here, we've had wars in Europe, we've had escalating fuel prices, we've had instability in Sino-US relations, concerns about the property market and the economy in China more generally, and of course, the imposition of rising levels of inflation and subsequent interest rates. Now, interest rates are perceived to be bad for growth companies for a number of reasons. Probably the two most prevalent being, firstly, on a valuation perspective, so future cash flows from these companies are discounted at a higher rate, which diminishes the present value of the businesses, but also higher rates make for a more expensive funding environment for companies that need cash. And all of that has been central, I think, to the derating that we've seen in growth equities in particular over the course of the last 18 months. Rates are now in the region of 5% in most developed markets, up significantly, as I'm sure you're aware, from the historic lows that we've seen over the course of the last decade. But this feels like a good time to take a look at the poll results. And I think they flashed up on the screen there. And it looks like quite a considerable proportion of you believe that rates will be lower in 12 months. Now, I'm going to take that as my answer, because you likely know more than me, and we do at Baillie Gifford, with regards to predicting where interest rates are going to go. We're firmly bottom up, and we don't tend to try and predict what'll happen. But one thing we are confident about is that we recognize that inflation and rates don't kill growth stocks. So the environment has undoubtedly changed, but we do challenge this notion, and you can see in the chart here on slide 4 that this shows Baillie Gifford's longest standing client and the compounded returns over 10-year periods at various points after inflation peaked. So you can see, for example, annualized returns of over 20% following peak inflation in the 1980s. You can see annualized returns of 15%, 16% after peak inflation in the 70s and in the 50s. So what I'm driving at here is that what's clear to us is that attractive returns can absolutely be generated after periods of peak inflation and interest rates. And what's even more interesting is that in our example here, inflation are at levels much higher than we're seeing today. So you can see that the UK historic inflation rate at one point was over 20%. Yet from that point onwards, the decade after that peak inflation point, returns were generated on an annualized basis over the following decade of 15%. So we think it's carefully selected companies can capably navigate inflation. Indeed, for many, it's likely to separate the winners from the losers. And the challenge for investors, really like ourselves, is to be able to identify the right companies in this environment. And we'll come on to talk a little bit about what we think the right companies are in the future. So we're not attempting to make like-for-like comparisons. There are many variables between different points in time. But I think one point is key, and that is that inflation and rates don't necessarily equate to being bad or poor for growth companies. But let's try and look through the noise a little bit. What really has changed, I think, whilst acknowledging that rates and inflation aren't central to the fortunes of growth companies, I think it's important that we recognise what has changed. Now, I really like the quote that's on this slide here from Warren Buffett, which is, only when the tide goes out do you discover who's been swimming naked. And that really alludes to the fact that we think that the current environment is likely to really separate the winners from the losers, the companies which are operating strongly from the companies that have merely been, if you like, sailing along on the coattails of these leaders at a time when interest rates are low, when inflation is low, and the environment is broadly supportive. So the environment and associated investor sentiment has changed. How has it changed? Well, I think pre-pandemic user and revenue growth was valued and rewarded by investors in share price terms. But I think the market's focus has shifted to proven business models, to free cash flow and earnings generation. That's what the market's looking for today. The rising cost of capital has increased the scrutiny on returns and on unit economics in businesses. So the robustness of the balance sheets, for example, how reliant are companies on debt financing? If they are, generally, that's not a good thing in the current environment. I think gone are the days when companies could build scale and sort of worry about profitability later. We've seen clear examples of that in our portfolio, with a number of companies aggressively pivoting and bringing forward their timetables for profitability. For example, we own a company called C Limited, which is an Asian e-commerce and gaming business, which is focusing in a much more laser-like fashion on becoming earnings positive and more disciplined with its capital allocation. Equally, Meta, a much larger business and well known to us all, formerly Facebook, is another holding in this portfolio. They described 2023 as their year of efficiency. So we're seeing that trend coming through with a number of growth businesses. So there's no doubt that the operating environment has changed, and there is a shift in what investors are valuing. But we don't think that the long-term prospects of companies are dictated by the level of inflation and interest rates. So what hasn't changed? I think the short answer is that earnings growth matters. Now, we've been investing for over 100 years at Baillie Gifford, so we've seen 2 world wars, Great Depressions, numerous stock market crashes, economic disasters, geopolitical traumas, all of which feels like we've seen very recently too. And we've made plenty of mistakes along the way. And indeed, last year was our worst year of performance on record. But that hasn't shaken our belief and our focus on the power of earnings as a driver of share price appreciation over the long term. So that remains undiminished. And that's what this slide on slide 6 really focuses on. So what it shows you is the stocks from the FTSE World and the FTSE Acqui indices, so 2 of the largest global equity indices, split into quintiles of earnings growth. So the fastest quintile of growers on the right-hand side and the slowest quintile of growers on the left. And then on the left-hand column, it's plotting the median delivered relative return over rolling 5-year periods. In simple terms, what it's showing you is the companies that deliver that top quintile of earnings growth are consistently the ones that deliver the highest share price appreciation over long periods. And that's a 30-year study. So that's a significant period of time upon which to base our thesis. And if you take an even longer track record, the same is also true. So I think that is the modus operandi for ourselves in managing the Monks portfolio. In the near term, it's less certain that the market will appreciate the strength of earnings growth for companies. I think that's what we're experiencing at the moment. But I think it's very possible that in the environment that we're in and that we may continue to be in for some time, that this greater focus that investors have and the market has on businesses proving their credentials could be very lucrative for growth investors if they can identify the right stocks I mean, that's really the key. And of course, it's never been easy. So what does growth look like, or how do we define growth? Our slide here on slide 7 sets out the way that we define growth within the Monk's portfolio and in our approach. Fundamentally, we believe that earnings can be delivered in different ways, and we look to embrace this within the portfolio. We have 3 different growth types. Ultimately, by being open-minded about where growth can come from, we think that we give ourselves the best chance of identifying some of these highest returning companies and owning them within the portfolio. And we'll come on to touch on some examples and evidence around, the top earners being spread across these different growth types. But let's just explore the types of growth that we believe exist today, and touch on a couple of examples within that. The first is our growth stalwart businesses. Now, these make up around about 35% of the Monk's portfolio today. And these companies are typically well-established businesses with large customer bases and a high degree of pricing power and loyalty entrenched within their users. The example that we've cited here is Shiseido, which is a Japanese cosmetics business. And that's a company that's seeing an increasing mix shift towards more profitable, high-quality, luxury, high-end cosmetic brands. And they're selling them increasingly into growing Asian markets. We're spending on these types of products is increasing over long periods. So, for example, in America, the average spend on cosmetics is in the region of $250 per annum. In China, that figure is just $20. So a combination of a fundamental structural growth in the amount that people spend on these types of products, and allied to Shiseido's market-leading position and strength of portfolio, is what underpins the growth prospects for that business. And once people start to use their products, they're generally very, very sticky in nature, and you tend to find a degree of loyalty associated with the brands that people purchase. Shiseido spends more than its competitors on research and development and is managed by a sensible management team, which we think is hugely important for a company that we perceive to be a steady compounding style growth stock. So in that sense, we consider this one of our highest quality positions. Now, the other growth type in the middle here is rapid growth. Now, these companies are, if you like, the maverick cousins of the stalwarts. They grow rapidly by way of disrupting existing industries or creating new ones. Earnings and profit growth can sometimes be a little bit further down the line, and heavy levels of investment are sometimes required to establish market-leading positions. And I think that's been the case with the example that we cite here in DoorDash, which is a food and grocery delivery business in the US. DoorDash has emerged as the clear market leader in the US food delivery market with about a 60% market share, so 2 to 3 times its nearest competitor, which I think is Uber Eats. So it's highly competitive. Now, the business has, we think, a really unique culture. For example, the CEO of the business spends 15 minutes each day, daily, on customer support, seeking improvements and constant iterations to the service level that they're able to provide both merchants and consumers on the platform. So that is both the restaurants that are accessing and using the platform and the individuals purchasing meals for delivery. We think that's a really, really unique example of where there is a genuine focus on the service that's being provided on an ongoing basis. And they've been able to make iterative improvements to their business model consistently over time. DoorDash honed its efforts in the suburbs in the US, where it's more difficult to be profitable because of the longer delivery distances involved. And by doing that, it's been able to finesse its offering and scale up this by moving into urban areas where profitability has been easier to generate. It's growing its revenues at 30% year on year, and we are, hugely excited and confident that it can continue to grow and build its position in what is a rapidly growing market. And it's a great example of what we believe to be a rapid growth stock. And then finally, cyclical growth companies. These are companies that are managed by teams that are skilled in capital allocation, i.e., looking to allocate capital in a counter-cyclical way. We know and acknowledge that the profits won't be evenly distributed over time, but we're looking for profit growth almost through the cycle. So we're looking for profit growth over long periods of time, acknowledging that this can be delivered, if you like, in a lumpy or uneven fashion. The example I've cited here is perhaps somewhat of a Marmite stock in Ryanair. Some of you may have had experience of flying with Ryanair, and we can't confess or should be honest enough to say that it's not always the most pleasant experience, but this is an exceptionally disciplined business. It's been through a difficult period through the pandemic, obviously with people not traveling, but is now returning back to pre-pandemic levels in terms of load factors. And if we take a longer term view, it carries around 170 million passengers today compared to just 85 million 10 years ago. Fares today are around half the cost that they were 10 years ago. And that's because Ryanair continues to lower its ex-fuel unit cost by way of being hugely efficient, growing at scale and taking share from competitors. So the underlying structural growth driver here, of course, is everyone's burning and insatiable desire to go on holiday and to have some sun, particularly if you're a UK resident, allied to the fact that the competition is often cash-strapped and inefficient, where Ryanair is very much the opposite. So we firmly back Ryanair as an example of a cyclical growth stock that we think can grow through this cycle that we're experiencing at the moment. Now, let's do another poll. Based on the descriptions that I've given you of the types of growth that we see in managing the Monks portfolio, the question that I want to ask everybody is, which of these growth types has delivered most of the capital appreciation for Monks over the past 5 years? I'll let you mull over that for a while. Now, I do have the answer to this one, where I didn't, with regards to where rates are going to go over the next 12 months. I'll go on to the next slide as we wait for those results to come through, but I think the important thing here is how do we know that embracing a breadth of growth really works? Well, we've been managing this approach for nearly 20 years, so the Monks portfolio since 2015, but the underlying approach since 2005. And when we've looked at the attribution and when we've looked at performance that's been delivered, what it shows is that the portfolio in aggregate outperforms much more often than any of the individual growth profiles. So that shows that the portfolio is better together than it is as an individual or standalone sleeve. Well, that's the results just in. So there's actually a pretty even split. So 43% of you think that stalwarts have been driving the performance. An element of which has certainly been true in the last couple of years, but they're the stocks that have held up best through our most difficult period. Rapid growth, 30%, cyclical, just under at 28%. The answer is rapid growth, but as I say, not by a big margin. And I think that's our experience. Our key is that actually we get a nice balance by looking to embrace these different growth types, and at different points in the cycle, each of the different growth types is able to deliver alpha, stronger returns, which is beneficial for the portfolio in aggregate. Another lens that we can use is what's on slide 8 here, which looks to highlight the biggest winners that we've invested in since back in 2005. Now, again, referring to the underlying investment strategy, which was completely compatible with Monks, but has been going since 2005. And we've chosen that because we have a near 20-year track record to base this information on. What you can see is the evidence of the big winners, exceptional returns being generated right across the growth profiles. So we have 3 rapid growth stocks in there. We have 3 cyclical growth stocks and 4 stalwart stocks. And you can see the very big winners, the Amazons and the Teslas, generating 124 times and 137 times our initial investment, are rapid growth stocks. So you tend to find in rapid that there's a tendency for these companies to deliver, exceptional returns, which is what we're looking for them to do. And conversely, that the compounders, or the stalwarts, as they're also called, in purple, they're generating really attractive returns, anywhere between 10 and just under 20 time returns. Exactly what we'd expect them to do over long periods, generating attractive, superior returns, but in a more consistent fashion. So we know that these growth types help from a diversification perspective, but then also the different individual profiles can deliver very attractive returns that contribute to the overall performance of a portfolio over the long term. So, we've talked a little bit about what we mean by growth, and the fact that that we still remain confident that growth is alive and kicking today. I think we tried to illustrate the benefits of thinking broadly about growth companies and why that's helpful for a portfolio, and that we've seen some of these long-term winners emerge. But what are the important characteristics, and I think I alluded to this earlier, that we look for in growth companies in this environment relative to what we've seen in the past decade, where inflation was low and rates were effectively zero? And I think that the short answer is that we think companies where there's a significant degree of pricing power, low levels of indebtedness, and ability to self-fund its growth is key. So on the slide here on the left-hand side, we give you some numbers around that are relevant for the Monks portfolio. Monks is around about half the level of debt compared to the industry or the index average. We've got significantly superior margins, so at the gross margin level, which is the one we look at with regards to pricing power, 40% gross margin versus 29% in the index. And why does that matter? Well, that matters because you're able to take a little bit of a hit on your margins and lower prices to outcompete your peers during difficult times. To some extent, we've seen that recently with Tesla. Tesla, which is held in this portfolio, has lowered average selling prices by 16% this year in order to outcompete peers and grow their market share. So that's an indication to us that this is a business with a superior financial characteristics that outcompete peers who simply can't do that. And then the final one relates to the proportion of the portfolio that's either earning per share positive or profitable, or free cash flow positive. So 95% of the Monks portfolio is in good shape in that regard. So with these attributes, as I've alluded to, I think what we're looking for these companies to do is outcompete their peers, and we cite some examples on the right-hand side. We've already talked about Ryanair, which I think is trouncing its peers, frankly, in the short-haul European airline market. But I think we could take Meta as one of the other examples on the page there. We think that Meta's advertising estate is hugely under-monetized and underappreciated. It has the ability to invest significantly more capital in making these services and offerings better, and indeed they're beginning to do so in a way that we think is going to be hugely valuable in the future. So I think there, when you compare Meta to its peers, the financial characteristics are going to bear fruit and drive growth for that business on a longer term view. So if we circle back, I think, to the start and Warren Buffett's quotes, the companies that have strong balance sheets and strong cash generation capabilities are the ones with the swimwear on, and these are what we hold in the Monks portfolio. So if we just broaden out our lens a little bit, and we've talked about the types of growth, the types of characteristics that we look for, I think we could also look at the thematic positioning of the Monks portfolio. And this slide on page 10 is intended to show that the portfolio's strength, I think, lies in its breadth and depth of exposure to multiple secular trends that will persist in our view, regardless of whether inflation or rates are at 0, 2, 4, or 6%. Now, the flywheel is quite difficult to read. I think that's testament to the variety of growth exposures that we have in the portfolio. You could say it's just pure artwork. I'll leave you to be the judge of that. But I think if we explore some of these themes, it's quite interesting in terms of how diverse in nature they are. So I thought I would touch on one or two. The digital frontiers, which is the proportion of the flywheel in green, which accounts for about 34% of the portfolio, encapsulates opportunities in digitization of the economy. So we're talking here about the likes of semiconductors, cloud computing, e-commerce, payments. These are all central to the digitization of the world that we live in today. And we think that we're still very early in that opportunity. For example, Amazon CEO Andy Jassy thinks that 90 to 95% of IT spend remains on-premise rather than in the cloud. So the cloud opportunity remains vast, and we think that that's likely to continue to be a significant contributor to Amazon's profits over the long term. We could look at something that's quite different in terms of capital advantage companies. In blue, that's around 20% of the portfolio. I think this is more critical today than it ever has been. I think at a time of more expensive and scarcer capital, companies with firepower have an advantage to use it strategically, by way of M&A at lower costs and valuations in a market where there are stressed assets available, buybacks at lower prices, or capex and spending to entrench and establish competitive positions. And there are a number of companies in the Monks portfolio where we think they are well positioned with that. I think none more so than Royalty Pharma, which is the example that we cite on the slide here. And Royalty Pharma is a US business that provides capital to late-stage biotech funding. It has a portfolio of existing royalties, which provides an income, and they reinvest that income into new opportunities. Now, they've set a 5-year deployment target of between $10 and $12 billion. The run rate on that is ahead of that, which I think represents the demand for its capital. So there's a premium on Royalty Pharma's capital because many incumbent providers of finance in that sector are stepping back. This means that Royalty Pharma is in an advantaged position. The deal flow and rate is increasing, and we think the potential for return generation for Royalty Pharma is exceptional, to the point where we're considering adding to that position, given our level of conviction. And the last theme I was going to touch on, just to try and illustrate the breadth of exposure within the Monks portfolio, was one in purple there, which accounts for about 14% of the portfolio. And this relates to the need for infrastructure spending, particularly in the US, where existing infrastructure, be it energy or transport infrastructure, is crumbling. Governments are beginning to, at the federal and state level, are beginning to commit to huge infrastructure spending projects. So, for example, estimates have suggested that the mega projects and infrastructure projects in the US are currently at 3 times the typical run rate, which is hugely interesting from a growth investor's perspective. And we think there are a number of beneficiaries that exist within the Monks portfolio, not least, for example, Martin Marietta Materials and CRH, 2 companies that focus on the building material and supply business. As railways and as roads are improved, these companies building of houses, these companies will benefit from a demand in volumes for their products and goods. Alternatively, something like Advanced Drainage Systems, which is highlighted as an example on the slide there. That's a company that manufactures, distributes, and installs plastic storm drains. And so today, most of the US's storm drains are concrete, they're crumbling, and they have a limited shelf life. These plastic storm drains are more durable, they're cheaper, and they're easier to install. And they are taking market share from concrete equivalents. So as the demand for that infrastructure renewal comes in, we've got plenty of beneficiaries in the Monks portfolio to drive growth in the future. So it really is a hugely exciting time to be aligned with a number of these secular growth drivers. And that's where we place emphasis in managing this portfolio, rather than what level of interest rate is the Fed or the central bank or the European Central Bank applying from one quarter to the next. So I hope that I've managed to demonstrate and take you through some of the key learning objectives that Hope outlined at the beginning. But I think some of the key takeaways that I'd like you to take away from what I've been talking about here was, first and foremost, that the growth investing is absolutely not dead, and it works over the long term. It requires patience and an ability to identify the right companies for the future. Growth can be delivered in different ways, and we should embrace that in delivering growth for savers in the future. And ultimately, we think Monks is pretty well placed to do that. And hopefully you've seen, both by way of a definition of growth and in some of the secular opportunities that we have, that it's an ideal offering for savers with a long-term perspective and that are seeking to deliver capital growth. So with that, I'd like to thank you all for watching once again. I'm delighted to take any questions that you have. The more, the merrier in that sense. So please do put them Hope's way, and hopefully she'll go easy on me with some of the questions you might have.
Thanks so much, Jon. We will now move into 15 minutes or so of questions. So we've got a good list here. Just to start us off, Jon, we're in the midst of some quite extreme times, geopolitically speaking, as you've alluded to. And as we know, volatility offers opportunities to stock pickers. So where are you seeing, I suppose, the most surprising opportunities in the market at the moment? Anything that you weren't expecting?
Well, I think what we've been seeing is opportunities, and we've been on a front foot, I think, with Monks in terms of where we've been seeing those opportunities. So to take a step back, the performance for the trust has been difficult last year, 2022, as I alluded to, and we took some time to really scrutinize the companies that were in the portfolio, and say, well, if there's going to be a period of higher rates and inflation, how are these companies positioned? And we undertook a weeding exercise, so we sold a number of holdings. But we very quickly then began to, as you're alluding to, look for where the opportunities were in the market, given the dislocations that we've been seeing between fundamental operating performance and share prices. And what we've been seeing is, I think, opportunities in the cyclical area in particular. So we've been investing in a number of housing-related cyclical businesses in the US. So, for example, I mentioned Floor and Decor with the storm drains that are associated with new build properties, but also in the likes of Floor and Decor, which is a hard flooring business in the US. It's systematically rolling out its offering in warehouses and across different states. The fears are being priced in there around the housing market in the US, which we think are overdone. So we were able to buy a position in that business at an attractive valuation. Pool Corporation is another new buy in housing-related sphere. So that is the new build, maintenance, and repair of existing swimming pool structures in the US market. But also in the cyclical sphere, in semiconductors, there has been, if you like, a significant semiconductor cycle at play. We've seen a number of semiconductor companies become increasingly attractive from a valuation perspective, and we've taken our semiconductor exposure from around 2% about 18 months ago to something like 7% today. That's included the purchase of Nvidia, which is a company that's in the limelight with regards to AI, but also a wider range of semiconductor businesses operating in the semiconductor supply chain. For example, a company called Integris, which makes cleaning and filtration equipment for semiconductor manufacturers. Just be one example. So a couple of opportunities in terms of the cyclical housing related market, semiconductors, and indeed just backing our winners. Hope, to be honest, there have been a number of the kind of rapid growth companies that we think the market is failing to price properly, and they're generating and operating very, very well indeed. I'm talking here about the likes of DoorDash that I mentioned earlier, but the Trade Desk in programmatic advertising, Meta, which is very much out of favor but performing very well in recent times. Li Auto in EV manufacturing in China. So a large number of existing holdings also receiving more capital.
Excellent. Thank you so much for that. Now we've got quite a long question here, but one delegate has said, I have a client who has held a balanced and well-diversified portfolio for a number of years. Clearly, the last few years have been challenging for clients with the ongoing geopolitical conflicts in the Middle East, and he is getting more nervous and is keen to move fully to a gilt fund. However, his money is held in a fully crystallized pension, so any withdrawals do have potential tax implications. Do you have any thoughts or comments?
Well, I think I have to be upfront about this and say that I'm not in the position to give any sort of advice as an employee of Baillie Gifford with regards to tax positions or indeed even what that individual should do in his specific circumstances. So I'm afraid I can't be much direct help there. I think where I can perhaps add some comments would be that to acknowledge first and foremost that it's been a very difficult time for investors, not only in Monks but more broadly in growth, and to say that certainly from our perspective, we acknowledge that some of these companies in the portfolio have been challenged. We've taken quite direct action in terms of reposition the portfolio to make sure that there's a healthy balance across these three growth profiles that I've talked about, and that we remain focused on what is going to add value and over the long term with regards to fundamental secular changes in the economy that I alluded to at the end. I think it's a difficult time for investors, but our perspective is that we're firmly focused on investing in these companies that can generate the earnings growth of the sort that we look for within Monks. And if they can do that, we really believe that is what will dictate the share prices on a very long-term view. That isn't much, if you like, solace to clients and investors who have seen the value of their investments fall sharply today. But I honestly believe by holding course and sticking true, that those people that stay on board will be handsomely rewarded over the coming years as the strength of this portfolio, which, as I've alluded to on a fundamental basis, starts to bear fruit and share prices recover sharply within growth investments.
Thanks for that, Jon. Now, you have talked about last year being your worst on record, and a couple of our delegates have said, what were the investments that you think or that let you down? And also, what was the biggest learning curve that you took out of the trust's experiences in 2022?
Yeah. So I think when we cast our mind back, when I alluded to making changes to the portfolio, there were a handful of companies, particularly within the rapid growth part of the portfolio, where on reflection, they didn't have the sorts of financial characteristics that I've alluded to today, that they probably were, I think, structurally challenged in a world where interest rates are higher. So, for example, Carvana was a holding in the Monks portfolio at one point, which is an online used car retailer in the US. Now, what Carvana did was borrow in order to purchase its inventory, purchase the vehicles that it then sold, but also it was selling the cars, the inventory, to customers who were themselves reliant on credit. In an environment where rates are rising and the cost of capital is increasing, the economics of that business becomes challenged. And also there's a threat to the demand that business is likely to get from investors or purchasers who are saying, well, actually, I used to be able to borrow $20,000 at 0.9%. To do the same, I'd have to borrow at 3, 4, 5%, and I'm not willing to do that. So that was one example of a company where, on reflection, it looked increasingly challenged in the current environment, and we sold. In terms of the lessons that we learned, I think the biggest lesson we learned was really the need to be balanced across the growth profiles. So at the course of the start of last year, we had too much in the rapid growth portion of the portfolio. There was an element or a portion of the portfolio where valuations had run up sharply in very short order. We did reduce a number of these positions, but I think we should have gone further, and we should have taken heed of the desire to be balanced across across stalwart, rapid, and cyclical growth. That's a position the portfolio is in today. We can tilt between the three growth profiles to a degree, but we took that to extremis. And that's probably the biggest learning point in terms of managing the portfolio going forward. And we feel we've quite directly addressed that.
Great, thank you very much for sharing. Now, someone has asked if you could please talk a little bit about how Monks differs from Baillie Gifford's other funds that share quite similar holdings. So, for example, Scottish Mortgage and Positive Change.
Okay. So Scottish Mortgage, I think the similarities, if we start there, and then we can maybe just tease out the differences, the similarities are a resolute focus on growth, a long-term investment horizon, and a focus on stock picking. Where the overlap with Scottish Mortgages comes is, and Keystone, frankly, the smaller overlap with Keystone, but where there is with Scottish Mortgage in particular is within the rapid growth part of the portfolio. So I think the overlap's in the order of 17% in terms of names. All of them are rapid growth stocks. So that is to say, Scottish Mortgage doesn't hold any growth stalwarts or any capital allocators, because Scottish Mortgage is all about a higher return hurdle and investing in these more rapidly growing businesses. Scottish Mortgage also has significantly more in unlisted investments. So I believe unlisteds make up around about 26-27% of the Scottish Mortgage portfolio. Unlisteds make up just 3% of the Monks portfolio. And lastly, Monks is a bit more modestly geared. Monks has around about 5% net gearing at the moment. I believe Scottish Mortgage is somewhat higher than that, more like the 15-20% range. In terms of Keystone, what you're looking at again there is a similar time horizon, focus on stock picking and appetite for growth companies. But again, Keystone is more concentrated, focusing on more rapidly growing businesses. And with Keystone, you have an important element is the ethical and the dual objectives around ESG, and a commitment to consider the Sustainable Development Goals in stock picking and the portfolio more broadly, where Monks is much more about a broader flavour of growth that I've talked about, and a more diversified portfolio.
Excellent, thank you very much for that. Now, somebody has asked if anything, what anything would the Monks Investment Trust do differently if this year could be started afresh?
This year? Well, I think, I think in all honesty, I think I'd have to reflect and say that, back to my earlier answer, and say that I think we would have taken more capital out of the more highly valued rapid growth stocks in the portfolio to the course of last year. In terms of this year, I genuinely think we're on the front foot, as I mentioned earlier. So we undertook a lot of research around some of these cyclical opportunities through the tail end of last year, through H2 last year. We've pushed the accelerator with regards to investing in a number of those in Q1 and early Q2. The middle part of the year, we've been investing in some of, or backing some of our existing winners that I alluded to. And today we have a portfolio that we think consists of our best ideas, that's balanced across the growth profiles. And in that sense, I feel very comfortable with where the portfolio is positioned today, acknowledging we might have made some of those changes through the course of 2022. But I think this year, I think we're comfortable and happy with the direction of travel. It's all about being patient and being active and true to what we believe in at a time when we think fundamentals and share prices are firmly out of kilter, because that's when we can add most value for savers within the trust. by adding and identifying these opportunities in the market.
Well, turning things the other way around, somebody has asked what you expect the biggest challenge to be for the trust in 2024.
So I think the biggest, the biggest challenge, I think, is probably going to be one that's out with our control to an extent, and that is that at the moment there's a huge certainty vacuum in the market, that such that that levels of consumption, inflation, and interest rates continue to be the subject of huge, I guess, huge ruminations and projections, and that is what is failing to give investors a degree of certainty around the environment for investment in the future. So the biggest challenge to us could continue to be the market's inability to say, actually, okay, rates are coming down, let's look fundamentally at where growth may be in 3, 4, or 5 years, rather than we're looking for that jam today. So to give you an example, the biggest detractor from performance this year on a sector basis for Monks has been energy. So energy is an underweight position in the Monks portfolio because we don't believe that oil and gas is where we want to invest savers' capital in a long-term view. But of course, energy companies today are generating record profits. So the market is valuing those businesses very highly at the moment because they're able to deliver them dividends and profits in abundance, where we're short on that type of investment at the moment. But as the rate environment, inflation environment normalizes and the market becomes more familiar with the operating environment, I think that's when we'll see a much more favorable environment for this portfolio. And that's probably going to be the biggest headwind for the portfolio in a short-term view. But I'm optimistic that will change and normalize on a medium to long-term view. And as I said, for all the reasons that I've outlined, Monks should be very well placed to benefit.
Excellent. Well, keeping with the theme of 2024, a slightly broader question here, but someone has asked, what can we expect from markets next year when we consider the effects of elections both in the UK and, of course, in the US?
Gosh, okay. Well, I think the caveat here is that we're very far from being anything like political forecasters, and nevertheless, then translating what might happen there into markets. I suppose the likelihood, in all likelihood, that the volatility we've seen in markets, of where, if you like, levels that we see at the moment, we would argue are likely to be towards the bottom of the market cycle. So if you're going to have significant political elections, be that in the US or indeed here in the UK, it's possibly, where all things being even, volatility should be expected. It's possibly not a bad time to see change happen at a political level on the basis that the only way could be up, given how far markets have fallen. So in that sense, we'd be reasonably optimistic that the direction of travel should be in a positive direction. I can't hold really any insightful comments with regards to the likelihood that Donald Trump can avoid jail and is likely to make his way back to being president of the US once again, or the likelihood of that, nor really what is likely to happen here in the UK. So I used to be a little bit, sit on the wall a little bit with regards to what's likely to happen, other than to say that given where we are in the market cycle, I think regardless of what happens, I'd be pretty optimistic that we can see a bounce back and continued recovery in markets.
A very comprehensive answer to a very difficult question there, Jon. So that does bring us to the end of the questions. Are there any final thoughts that you would like to share with our delegates this afternoon?
Well, I think mainly just to say, firstly, thank you again for dialing in, taking your time to do so. Um, I hope that I've given you a little insight into how Monks thinks about the opportunity set and the merits of our approach. I think the final word would be a bit of a rally cry to say things have been difficult for growth investors, but you know that doesn't mean that we should anchor off what's been a difficult period. We need to look forward, and we're very optimistic that there are much better times ahead. So if, by holding course, as we will firmly do, we hope that investors can generate significantly more attractive returns in Monks and more broadly within growth assets as we look forward in the coming years ahead.
Wonderful. Thank you, Jon. Well, that is a great place for us to leave things for this afternoon. So before we wrap up, let's just take a quick look at the learning objectives again. Thank you very much to everybody who asked a question, and thank you, of course, very much to Jon for joining me. If you did have a question that didn't get answered, Jon and the Baillie Gifford team will do their best to do so after the event. And before we close up, a quick reminder again that your CPD will be delivered tomorrow. Now, let me just leave you with a little teaser of what's to come from PA events for the rest of this year. Next month, Professional Advisor will be back on the road again for our very popular retirement planning roadshow, where you'll find us in Harrogate on the 14th of November, in Warrington on the 15th, Birmingham on the 19th, Bristol on the 22nd, and in London on the 23rd. The keynote speaker for the Retirement Planning Roadshow will be Intelligent Pensions Technical and Compliance Director Fiona Tate. You'll also hear presentations from Aviva Financial Advice, Legal & General, Premier Miton, Tatton Investment Management, and 2 more speakers to be announced shortly. We're going to be finishing the year with 2 more of these digital working lunch events in December. So on the 6th, we're back with Baillie Gifford and a presentation entitled Living Longer and Prospering. And finally, on the 12th, we close out the year with Schroders and a review of their ever popular financial advisor Pulse survey, as Gillian Hepburn, Doug Abbott, and Unique Financial Planning's Philip Martin discuss the thoughts of advisors as we move into the new year. All in all, that's a total of 5 hours of CPD for you, and you can find details of and register for all of these events on the Professional Advisor website, and you'll find that underneath the Events tab on our homepage. So that's it for today's session. All that remains is for me to thank you once again for your company this lunchtime. I trust you found the session helpful and worthwhile. And if you did, perhaps we will see you at another PA event very soon. Thank you and goodbye.